Let me begin by noticing that the title of this panel, Central Bank Communication Current Challenges. My bet is if you go around the room, that means different things to different people. So we could have had a panel, Communication Current Challenges, because of course every organization faces a communication issue now in the world of new media, as the President was saying, yes, with deep fakes, all sorts of misinformation, disinformation. So everyone in the world can talk about communication. And then when we go to central banks, as Claire just also indicated, one element of that is communicating about the central bank as an institution. So whether that's the mandate, explain what the mandate is and is not, whether it's about explaining why uniquely, in many ways, central banks have a lot of delegated independence. There's a lot to communicate about there. But then, of course, we also have the more narrow topic of monetary policy communication. And then within monetary policy communication, one question is, whatever you've just decided, how do you communicate your current decision, but also the pros and cons of communicating about the future. So Andrew Bailey yesterday noticed that it's not always the case that a conditional statement remains conditional. There can be a filter where something that's accurate conditionally suddenly becomes an unconditional communication. But on the other hand, there are pros and cons. So we're going to cover a lot with the panel members we've assembled. And then maybe coming back also to a pretty basic issue. Central banks are public institutions, and behind everything is a default of transparency. So that's also very important in many ways. Maybe I'll also before handing over to the panel, I recall Ben Bernanke famously had this ratio. That monetary policy was 2% action, 98% talk. I'm not so sure that ratio is preserved. But maybe by the end of the panel, let's see if we have a new ratio to think about. So with that, and as Claire mentioned, I mean, it's important for this panel to come up with a range of different backgrounds. So I'm really pleased that the first presenter is Alessandra Galloni, who's editor-in-chief at Reuters, because I think the risk would have been, if there's only central bankers here or academics, how what we say gets intermediated by important intermediaries like Reuters and their competitors is so important. So Alessandra, over to you.
Thank you. I'll go. Thank you, Philip. So first of all, I have two disclaimers. The first one is I don't have a presentation and I don't have any slides, and I have very few numbers in what I'm about to say. So that makes me a little bit of an outlier today. The second one is, despite the theme of this panel, I'm afraid that I cannot give advice to central banks on how to communicate because, like you, Reuters fiercely guards its independence. That said, I can explain how we, one of the world's leading providers of financial news, work on the other side of the communication spectrum from what you're going to hear from the other panelists. And in particular, how we navigate some of the political and societal pressures that we and other news organizations increasingly face as we report and deliver the news. And two, how we are using AI to help us report, edit, and publish the news, even as many people, including President Lagarde just yesterday, expressed legitimate concerns about this technology. So we, news organizations, perhaps like central bankers, face, I think, two overriding challenges: credibility amid uncertainty and technology. For us, so from our point of view, for years now, we've had a years-long rise in misinformation, disinformation, fabrication, conspiracy theories that have created a new epoch, if you will, of epistemological uncertainty. Most of you know Reuters from our presence in boardrooms, in central banks, in corporate boardrooms. But actually, among our 2,600 journalists, we have many on the front lines of world wars. So Ukraine, Russia, Israel, Gaza, Iran, Lebanon, Sudan. And there, the temptation for propaganda is very high. And there, sifting fact from fiction is often a question of life and death. Then, in the official halls of many governments, increasingly distinguishing true from false is difficult. And in many countries, including in the United States, the media is under direct and fierce attack from political leaders. Perhaps sounds familiar. And in part due to these attacks, the public doesn't trust the media in the way that it used to. Trust in news across markets globally is pretty low at 40%. This is according to Reuters Institute, a think tank based at Oxford. So for us, transparency, and Philip mentioned it, is a big part of the solution. Our legitimacy rests on sustained confidence that we provide factual and fair information. And so, for example, this includes that we issue clarifications and corrections or retractions promptly and comprehensively. And also, it includes being honest about the inherent limitations of our reporting by disclosing in our coverage, in our stories, not only what we know, but also what we don't know. So, for example, I'll give you a couple of examples. We recently wrote a story about the U.S. Defense Secretary who who ordered a halt to flights with weapons to Ukraine, but didn't tell President Trump. And this was an important article in the context of the current relationship between D.C. with Kyiv. And it relied, this article, accurately on many unnamed sources. But we didn't have all the details. And so in our story, we were very clear that we didn't, including with sentences such as, Reuters couldn't establish when the flights were ordered canceled, or Reuters couldn't determine if Hegseth or his team knew how the order would play out. Or two people familiar with the matter denied that there was a true cutoff in aid, and one described it as a logistical pause. Another example is a recent story we published, you might like this one less, about how some European central banking and supervisory officials are questioning whether they can still rely on the Fed to provide dollar funding in times of market stress. Now, the story was rock solid. It was based on 6 independent sources. But we were also clear about what was not happening. And so we included sentences like, the sources consider it unlikely that the Fed would not honor its backstops. And the Fed has never suggested that it would not stand behind its backstops. A Columbia Journalism School professor who commented on the first story that I mentioned said in a blog post, this level of candor did not diminish the story's credibility, it strengthened it. Another way we try to build credibility with audiences is to cover the story, but not to become the story. So for us, being out of the spotlight helps us to report the news reliably. Journalists are perceived as less trustworthy if we wade into political, societal, or economic debates. And setting our opinions aside and being humble, as Governor Bailey said yesterday, about the possibility that our hypotheses may be wrong are key ingredients to maintaining trust. Our coverage and the impact, hopefully, that has on people's decisions, people's lives, should speak for itself. And again, I think there are some parallels here from some of the themes that have emerged over the past couple of days in central banks. So the second challenge is technology, and I'll spend a little bit more time talking about this. So social media platforms have for many years democratized access to news, and that's a great thing. For those of us who believe in the power of information, that's great. But they've also made it easier to propagate unverifiable and distorted views. And of course, the rise of generative AI, which can generate very high quality, increasingly realistic text, images, and other content. I mean, we sift through, I could do a whole other presentation on some of the images that we have to verify every day. So this has turbocharged this dangerous phenomenon. It's difficult to accurately measure the increase in this problematic material that is out there. NewsGuard, which is a service that evaluates news websites for reliability, says that in the last year it found 794 news and information websites in 16 languages that use unreliable AI-generated content. And Europol Innovation Lab is predicting that the vast majority of all internet content will be synthetically produced by 2026, so just in a few months. At the same time, used responsibly, AI does offer us real opportunity to improve the way that we cover news. So as you all know, we deliver news to markets through a financial terminal owned by the London Stock Exchange Group. But we also reach more than 1 billion people a day through all of our thousands of customers, news organizations around the world that are our clients, and of course via our own website. In delivering news to all these audiences, but particularly to the markets which operate in fractions of a second, we have to always balance the need to be right with the need to be fast. Now, when there's a trade-off, accuracy always wins out, of course, but generative AI is helping us to sort of square, if you will, this speed-accuracy circle. And here is how. So for years, we and other news organizations have used various technologies to extract facts from corporate financial results and from central bank statements. And we publish them automatically to the terminal. Now, for an increasing number of corporate results, and soon for official communications like central bank communications, we're using an AI tool called Fact Genie. This uses an LLM to extract facts from lengthy corporate releases. We also have tools that recommend headlines for a story, and we're now experimenting first drafts of stories. Now, I want to be clear. A journalist always checks the accuracy of this content before publishing. But not only, we also disclose to our public, because again, disclosure, transparency is important, that the AI tool has been involved in the creation of the story. Fact Genie, this tool, is allowing us to publish twice as fast as before, and we've only been using it for a few months. We expect it to get even better. We also use real-time transcription and translation tools. But again, their output is never published without human validation and always with disclosures. Our central bank reporters and editors are also getting helped by the AI tools. They're experimenting with other AI tools that they run through long central bank communication, so sort of the minutes of meetings or monetary policy and financial stability reports or the beige book in the Fed's case, to help us find signals amid the noise. So for example, we used it just on the assessment of April's liquidity crunch in the Treasury market. Was it more dire? We tried to measure it versus was it more dire than the early days of COVID? Or were farmers and food processors in the Kansas City Fed's district the only ones that were worried about the effect of immigration, say, on their labor pool, things like that. Soon, AI technologies will be reliable enough for the machine to suggest news headlines and stories in real time based on the spoken word. And soon, these AI tools may even be able to create news based on sentiment. UBS, and I was talking to someone from UBS last night, has built a massive database of central bank news and speeches over the past 30 years and uses an AI tool to model the shift in the tone of communication. They say that such tone shifts detected from aggregate communications is a leading indicator of market pricing and actual policy action, and they rate it on a sort of hawkish and dovish scale. But importantly, what have we learned, over the past sort of year or so of using these tools? So far, we've learned that AI is very good at condensing the main message of a long policy speech into digestible alerts. But the AI models produce a significantly larger number of news alerts than those created when a journalist handles the coverage. So the point is that AI will get to the real news faster, but it's also likely that the key news or the intent or the subtle adjustment in a 5,000-word, for example, ECB speech could easily be missed. In fact, it most likely will be missed. So what we're doing, in addition to human intervention and disclosure that I mentioned, is we're trying to reduce the overload. So despite the higher volumes that Fact Genie is recommending, Fact Genie recommends a lot of things that we could put into alerts and stories. We've actually made a real effort to reduce the number of our alerts, of our headlines that we publish to the terminal. Just this year, we've reduced it by 15%. So we're trying to, if you will, we're trying to be kind of a counterbalance to the machine. We're also training FactGenie to publish alerts that are deemed highly newsworthy based on the judgment of our team. So we're trying to teach the machine news judgment. Not working so well yet, but of course, machines make mistakes. And because news cascades so quickly, errors are going to be reproduced on countless platforms. And inevitably, correcting them is going to be difficult because it's going to be a human who has to correct them. So just as an example, anytime any of your central banks do maintenance for your websites, our monitoring system picks up a flood of items thinking that they're new. Most of these have timestamps or dates, so that helps, but it doesn't eliminate the risk entirely. We're also focusing how to use humans and technology to detect errors. That's another sort of stopgap we're trying. So again, to detect them quickly and comprehensively, because again, correcting errors is key. There's another risk. Central banks often generate considerable noise. So the ECB Council, 26 people who all speak, and AI, it's not such a bad thing for us, but anyway, AI will struggle to capture the real news when there's an abundance of competing voices, generating a great deal of output. And then, of course, there are things that AI just can't do. AI cannot have an off-the-record conversation over lunch. In the case of Reuters, it'll probably be a cheap lunch, but an interesting lunch, and gain an in-depth understanding of the topic. It can read what is published, but it will struggle with what is not published. So, and often, as you all know, it's the omission or it's the word change that gives you the nuance with the key message, or for us, the key story. And it struggles, and this is key. I know somebody else is going to talk about who gives the message. It struggles to distinguish between the relevance or among the relevance of certain voices. So it will fail to understand the significance of a of a dove, for example, making a relatively hawkish comment. And so that brings me to the end, and the greatest opportunity I think that AI is providing for us is that using AI tools responsibly for our real-time market news frees up our journalists to do that which only humans can do. And that is reporting out that distinctive, nuance, the insight, the analysis, the interviews, the source-based stories that are valuable both to a sophisticated market audience, but also to our more general, global, and very, very large audience. So to conclude, my last point, I actually asked the AI model called Claude to suggest a possible closing paragraph for me. And this is how it responded. I understand you would like a concluding paragraph for your speech, but as Reuters editor, you should understand that I cannot generate original speech content for you to deliver at the European Central Bank. This would conflict with Reuters' principle of independence and journalistic integrity that you have highlighted in your own speech. So maybe there is hope yet.
So no doubt many of the topics Alessandra raised will come back in the course of the panel. I will say a clear byproduct is, as we see all the research coming out, central bankers are getting very self-conscious because the tone of voice, how you appear, facial expression, all of these are now coded by the AI. So it's kind of, it's impossible to get up in the morning. Let me next turn to Carolin Pflueger from the University of Chicago. One of our key audiences, of course, is the professional audience, and understanding how they learn about the reaction function is so important. And maybe, again, coming back to the Bernanke 298 ratio between talk and action, or action and talk, I should say, this is going to be revisited by Carolin. So over to you, Carolin.
Thank you so much for including me. I will talk about perceptions about monetary policy in 2025. This is, of course, based on joint work with my terrific co-authors. We live in interesting times for monetary policy. After the pandemic of 2020, inflation spiked in 2021 to levels not seen in 40 years. Initially, policy rates in most advanced economies remained at 0. But then, over a year later, the ECB lifted off in July 2022, reaching a peak in late 2023. Since then, inflation and rates have gradually come down. A well-perceived monetary policy framework matters for at least 3 reasons. And we've just concluded, we heard about the conclusion of the framework review, right? This needs to be absorbed by the public. Well, first, it accelerates transmission through financial markets and allows markets to do the central bank's work for it. For example, if the ECB's reaction function is known, markets can react appropriately to macroeconomic news, thereby moving relevant rates even before the next policy meeting. Second, many have argued that a high perceived inflation reaction can improve the inflation output trade-off, meaning that it is possible to bring down inflation more easily and at less economic cost. And third, bond market safety and monetary policy credibility are interlinked with the broader economic and policy environment, including geopolitical safety. The core of my comments will be centered around the question, how did perceptions of the ECB's monetary policy framework change during the recent inflationary experiment and beyond? And we have 3 main findings. First, the perceived inflation reaction rose substantially between 2021 and 2023, from basically 0 to 1. This means that the Taylor principle was satisfied once the tightening cycle was underway. Second, high-frequency bond yield responses also strengthened in response to inflation surprises and have remained strong through the most recent data. This is consistent with an increase in the perceived inflation reaction and is good news for the ECB's long-term credibility in controlling inflation. Third, bond stock co-movements turned positive in late 2023, which can also be attributed to the new perceived inflation reaction when supply shocks are present. These findings have implications for monetary policy communication. Most importantly, I want you to take away that there are tools to measure the perceptions of the monetary policy framework, which is useful to evaluate whichever communication strategy you choose. Moreover, both the timing of the increase in the perceived inflation reaction and subtle differences between Europe and the US suggest that actions matter. Markets and observers perceive a higher inflation reaction after a hike in times of high inflation, or more relevant right now, are easings that are clearly dependent on incoming inflation data. Further, quantitative data, such as we use in our analyses, is useful. So central banks may want to get in on that game and publish their own data that can help communicate the framework through quantitative communication viewed most broadly. All right, so let's turn to the data. This figure shows the raw data from the ECB's survey of professional forecasters that we use to measure the perceived inflation reaction. The perceived inflation reaction here is basically the slope in this plot between inflation forecasts on the x-axis and policy rate forecasts on the y-axis. So one dot in this picture here, for example, might be the forecasts for inflation and the policy rate by one bank, let's say Société Générale, for the next year. A different dot might be different financial institution or economic consulting group with a different forecast horizon. There's a steeply upward sloping relationship here. For example, a 1.5% inflation forecast was associated with a rate forecast of 2.4%. By contrast, a 2.5% inflation forecast was associated with a much higher rate forecast of 3.6%. This is exactly what we would expect to see if professional forecasters are using a monetary policy rule with a slope greater than 1 in their models. This is from a single survey wave, the first quarter of 2024. Let's see what happens when we roll this forward across different survey waves to understand how the perceived inflation reaction has changed. That's what we see here. So the dot, for example, one dot here for the first quarter of 2024 corresponds to the slope that you saw in the previous plot, which we saw was greater than 1. Here we see that all the way through 2021, 2022, as inflation was on the rise, the perceived inflation reaction was pretty much zero. Then, after liftoff, the perceived inflation reaction started to go up and eventually reached a level higher than 1, consistent with the Taylor principle. This figure uses completely different data and also finds that the perceived inflation reaction has increased. Here on the x-axis we have date, and for each dot what I'm showing you is the rolling regression coefficient of daily changes in bond yields onto inflation surprises over a 24-month rolling window, where each observation is a core CPI release date. What we see here is similar. The inflation reaction of bond yields remained fairly low through 2021, much of 2022, and then it increased. Moreover, the perceived long-term inflation reaction as embedded in these high-frequency bond yield responses has remained strong through the most recent data. Here I'm turning to bond stock co-movements. And concretely, I'm plotting the inflation component of bond stock betas measured as the regression of inflation swap returns onto stock returns over a 90-day rolling window. What I'm highlighting here is that this bond stock co-movement has increased in the fall of 2023. This has sometimes been billed as a return to the turbulent bond markets of the 1980s. I think time will have to tell whether we really get back to that, but there has been an increase. There is also a shorter-term peak, especially for Europe, around the invasion of Ukraine, as you can see here, suggesting that shocks on the supply side and geopolitical shocks have played a role for inflation expectations and bond market safety. There's a logical story here. When supply shocks are present, central banks, monetary policy need to choose a point on the inflation output trade-off. When the perceived inflation response is strong, as in late 2023, this means that stock markets are going to decline more in response to an adverse supply shock. Bonds also fall because inflation goes up, and a positive bond stock co-movement ensues. The increase in the bond stock co-movement that we see here hence further supports an increased inflation reaction, as I showed you before. Let's now broaden a little bit from narrow monetary policy communication to the broader environment. We already saw on the previous slide that geopolitical shocks matter for inflationary concerns and bond market safety. Zooming out, here we are looking at borrowing rates, government bond rates for the UK in dashed and the US in solid back to 1870. We see that the UK enjoyed the lowest borrowing rates before World War I, when it was also the largest military power worldwide. However, it lost this privilege sometime between the big world wars, when its hard power was also overtaken by the US, and the US then has enjoyed the lowest borrowing rates. In ongoing work, I have modeled the two-way virtuous cycle between geopolitical safety, low borrowing rates, and the ability to invest in military capacity. So geopolitical safety should be viewed not just as an underpinning, but also as a result of monetary policy credibility. Okay, to conclude, perceptions of the monetary policy framework matter for transmission to financial markets. It allows markets effectively to do the central bank's work for it. It can improve the inflation output trade-off, and it also matters more broadly, including for geopolitical safety. We have found that the ECB's perceived inflation reaction rose after the liftoff from the ZLB in July 2022, basically from 0 to 1. In our last year's paper for Jackson Hole, we found something very similar for the US. Further, in the 2025 update, the longer-term perceived inflation reaction of the ECB remains strong, and that's good news for the ECB's long-term credibility in controlling inflation. One big takeaway here should be that there are tools to evaluate and measure perceptions of monetary policy frameworks, and I think that's useful, especially when communication tools are under discussion. Most concretely, we have found that the rise in the perceived inflation reaction occurred after liftoff and repeated hikes. That means good monetary policy actions are good communication. That should give an additional reason to hike quickly in a potential inflationary scenario, or more relevant right now, keep easings clearly dependent on incoming inflation data. The data that I've shown you is from private forecasters, but central banks, in principle, have the ability to make similar data available themselves and thereby use this to communicate their own reaction function. I'm thinking here of several possibilities: connected dot plots, scenarios, or quantitative communication more generally. Thank you.
So among the factors that Carolin raised in that wide-ranging presentation is, in fact, of course, the markets and everyone don't just care about the short-term policy rate. They understand, want to understand also the wider evolution of interest rates over time, not just in terms of our projection horizon, but when we look at longer-term rates, the credibility of institutions in relation to governments and so on. So in any event, this is the Central Banking Forum. The ECB likes to learn from our neighbours and further afield. This is why I'm so pleased that we have Anna Seim from the Riksbank next on our list. So over to you.
Thank you, Philip. So I'm just waiting for my slides. So thank you very much for allowing me to speak today. I'm very happy to be here, and I'm going to talk about the role of alternative scenarios in monetary policy communication. So let me start by noting that although I think that most of us agree that efficient communication is a key part of monetary policy, we have actually chosen very different strategies in this regard. And this is probably due to differences in institutional features, that we face different constraints, but also different possibilities. So at the Riksbank, the path that we've chosen is one of very high transparency, and I think that there are essentially two reasons for this. One is, of course, that we're highly independent, and with this independence, as you know, comes this need for accountability, which is facilitated by transparency. But also that we believe that it makes monetary policy more efficient if we can influence the expectations of households, firms, and markets. So to this end, what we're doing is that we try to convey the reaction function of the board by publishing a policy rate path, a forecast for the policy rate for the coming 3 years. We have been doing this for almost 20 years now, with some success, I would argue. But we complement this path, complemented by alternative scenarios, which will be my focus today. And we also publish attributed minutes shortly after each policy decision, so 5 working days after. So it's quite clear who said what and who expressed different nuances to the consensus view. Now, before I get to the scenario part, let me just comment briefly on the policy rate. So this is a policy rate path that reflects the majority view of the executive board. So we stand behind and own this forecast. It is produced by the staff, but in discussion with the board, and this is very much something that we take a decision on and stand behind. It's a path that ensures that the objectives are met, so that we meet the inflation target while taking the evolution of the real economy into account over some horizon that we think is reasonable at the time. And it's also consistent with our assessment of the long-run neutral interest rate, so that everything sort of holds together in the long-term equilibrium. There are a number of properties that we want the monetary policy embodied in this path to obtain. In particular, we want it to be efficient. There should be no other path that brings us to target at a lower cost. It should also be robust in the sense that it should give rise to acceptable outcomes if things don't evolve as we foresee. And it should be predictable, so it should be in line with historical reaction patterns, and we can also benchmark against, for instance, Taylor rules and so forth. Importantly, it's revised as new shocks hit the economy, so we constantly convey that this is a forecast, not a promise. So in the language of forward guidance, this is very much a Delphic type of forward guidance. It's not a commitment to any given policy. So this is the example from the most recent monetary policy report in June. So what you see here, the dashed line is the path. We lowered the policy rate by 25 basis points. That's why you see the blue line being lower than the previous forecast from March. And it's also absorbed by the interval that we think is reasonable for R star in the very long term. So over a 5-10 year horizon, it should be absorbed by this interval for R star, which we currently think is 1.5 to 3% in nominal terms. Excuse me. So since we can be certain that the future will not evolve as we foresee, we complement the policy rate path by these alternative scenarios. And I think it's easy enough to say that, inflation could be higher or lower, and if that happens, we respond by means of the interest rate. But I think we can add clarity by being a bit more specific and by adding some detail. So if we think about what a scenario comprises, it's really a sequence of shocks. These can be one or several different types of shocks that occur at different stages. But it's also a set of modeling assumptions. How do we think about the strength of the monetary transmission? How do we think about the degree of price rigidity, the state of the global economy, the pass-through of exchange rates to prices, and so forth? And what we obtain is these alternative projections when we subject our main model apparatus to these shocks under these alternative assumptions. So the main objective of these scenarios is to convey which risks we perceive as important, but also the reaction function. How are we likely to react if this is happening as we see in this scenario? And they can also be useful for assessing policy robustness. So if we think about the baseline and we think about alternative scenarios, we could derive optimal monetary policy in all three cases, apply that policy to the different states of the world, and see which one gives rise to the most acceptable outcomes in all three cases. I like to think about scenarios as these coherent macroeconomic narratives that allow us to address the what-ifs of the economy. So this is an example from the December 2024 Monetary Policy Report. Here you see the blue line is the baseline, and then we had three different scenarios. One where inflation was lower, but two scenarios where inflation was actually higher than in the baseline. So in one of these, in the yellow one, we communicated that what if there are tariffs that increase inflation, there are second-round effects, we could think about some entrenchment, we could think about inflation expectations being affected. And in that case, we sketched a more restrictive monetary policy. So the yellow line that you see in this right panel, that would be the anticipated policy response in that case. But what happened a few months later is that we had higher inflation, but not due to tariffs, but due to temporarily higher food prices, due to a reweighting of the consumer price index. And here it really gets crucial that we did talk about the details, because some of the market participants picked up on the fact that we didn't raise interest rates as we had sketched in the scenario. And that was because the underlying inflationary pressure was different, and we didn't see any real threats to inflation expectations, for instance. So I think this illustrates some of the challenges that we see when working with scenarios. One is clearly how to choose them. How do we identify the risks that the executive board see as the most pressing ones at the moment? Should they be close to the baseline or more extreme? How specific and detailed should they be? And I think there are different views here, but one principle that I think is perhaps appealing to me at least is that if we are close to the baseline, we should pay attention to detail. It should be about the mechanisms, how we see the inflationary pressure in the economy, and not just about observing different outcomes and saying, if inflation is high, we're going to raise the interest rate. If we talk about more extreme scenarios, other challenges are that they're not easily addressed by means of the model apparatus that we have access to. I mean, if we want to model the general equilibrium effects of a trade war, that's clearly going to be very difficult. The same goes for many other geopolitical effects as well. But ideally, scenarios should receive as much attention as the baseline projections. So we should really go that extra mile, I think, and pay some attention to detail. Now, do scenarios work? They are notoriously difficult to evaluate. It's very hard to say that we have established causal effects. If we look at the deviation of market expectations of interest rates from our policy rate path, there are some episodes when they have been much more in line with our alternative scenarios. This is, of course, not to say that we have influenced market expectations, but they have at least been consistent with the scenario view, and they have deemed these scenarios relevant and realistic. And we do know that market participants study them. I'm not so sure about households and firms. We don't have any data on that. But to conclude, in my view, the policy rate path and the scenarios that we work with are useful in painting this comprehensive picture of our reaction function. I think scenarios are particularly useful when uncertainty is high. In normal times, we can be a bit more confident in the baseline, but in uncertain times, we really need to think about the what-ifs. And one thing that we learned from this December scenario that I mentioned is that if we address past scenarios in the monetary policy report, that's something that could contribute and promote credibility, in that we can say to what extent or in what regard does the actual development of the economy differ from the scenarios that we addressed in the past. And barring the challenges involved in evaluating monetary policy communication, I would say that this communication strategy has been successful. There is some indication that monetary policy has been predictable. We've seen very small market movements, for instance, in response to policy changes. And so I think even in times of uncertainty, we have been fairly successful in this regard. So thank you.
So continuing the tour of different central banks, I'm pleased that we have Alan Taylor, who's, as an external member of the MPC, he's also continues his day job as professor at Columbia University. So Alan, over to you.
Okay, thank you, Philip. Thanks for the invitation to be here. So why do central banks talk about their decisions in public? For a long time, monetary policy was decided and implemented behind closed curtains, something that I study as an economic historian. But in my view, there are two reasons why that's not a good idea. First, we explain our decisions and intentions because we believe it's conducive to both understanding of and trust in the institutional framework. In the UK, this means a delegation of inflation control from the government to an independent central bank, and then implies the independence of the MPC for setting the stance of monetary policy in order to hit the statutory target. The second reason for explaining decisions and intentions is because of a desire to affect expectations of future interest rates, either directly or indirectly by affecting expectations of the macroeconomic outlook. Today, I'm going to speak about this latter point. The question I address is, how can central banks credibly and usefully communicate when it comes to where interest rates are likely to settle in the long run? And I will argue that the arc of history bends towards greater transparency and that we, the Bank of England, still have a way to go. My individual view, and not necessarily the view of other members of the MPC, is that this is one key dimension along which we could be more transparent. And further, I will argue that I think we should be. I believe there is value for central banks in communicating policymakers' beliefs about the neutral interest rate, whether it be some collective view or that of any individual member. Now, this is not the same as forward guidance because it is not intended to affect the stance of monetary policy or be a commitment. Instead, it is about giving an anchor to the endpoint, the neutral rate, the place where interest rates would come to rest after all shocks, real and nominal, have washed out. Of course, that place is never reached. Shocks happen. But just like any other possibly time-varying parameter in our reaction function, it is something we should strive to convey, to make that reaction function ever more clear to the outside world. If we think it's important to explain the slope parameters in that function, it is, I would argue, at least, if not more important, to also communicate the intercept parameter. Naturally, since neutral is an unobservable, talking about neutral is to express a belief. And as with most of our other communications, these beliefs can be wrong. I would argue, in fact, that they are ex post almost certainly going to be wrong most of the time. I've said that before, just as in cricket, you should expect to get out sooner or later, so in monetary policy, you should expect to make an incorrect forecast. But that should not mean that we stay in the pavilion and hide. We should share our beliefs and be scrutinized for them, a test that we should be able to face. However, this raises another question. Even if we were to talk about neutral, would we actually have anything useful to say? Our expressed beliefs can only be as credible as the method that underpins them. So what methods are available? I will highlight three approaches in use. One method is analyzing, using models and data to gather evidence. Another is the method of outsourcing, using the market curve to gauge other people's assessment of neutral. Or there is the method of feeling our way to neutral, a view that we will know what neutral is when we see it. An objection to feeling our way by trial and error, or by hiking or cutting until something breaks, is that the ensuing mistakes from under or overshooting, or from instability or other risks, could be costly. An objection to outsourcing to the market is that the market can be wrong. I'm a little bit behind my slide here. And I'm going to show this famous or infamous chart. The market can spend the better part of a decade being wrong, actually, as we saw in the 2010s. And this chart shows the evolution of short rates in the UK and the US over the past 20 years, alongside a series of successive market curves. It's not showing every market curve. There's a degree of uniformity there. But we can see how it took several years for financial markets to realize that short rates would stay low, ostensibly because R-star had fallen in the wake of the financial crisis. In fact, it's ironic that when markets were finally fully convinced of lower for longer in the UK and elsewhere, it was on the eve of the largest inflationary shock in a generation, which caused central banks to raise rates rapidly in response. In my view, however, the recent unanticipated rise in rates was mostly due to the unusual combination of shocks and their severity, and not because the drivers behind the lower neutral rate went away. All of the structural issues, aging societies, low productivity growth, a global hunger for safe assets, all those things are still around. The link between these slow-moving structural drivers and neutral rates is not directly observable, so one needs models that embed at least some of these mechanisms and trends. Thus, my preference is for the first option above, the use of analysis. Now, a frequently stated objection to model-based endpoint communications is that the models are simply too imprecise. So let me gently push back on that idea. In the note, which is going to be published alongside these remarks, we do some exercises. We show how model-based estimates of neutral interest rates have actually been better at predicting future short rates than the bond market itself, on average over recent decades, not just in the decade shown in this chart. Our setup in this exercise is deliberately simple. We take the model's equilibrium real rate, R-star, and its inflation trend, pi star, recursively estimate a time-varying intercept. We can also switch that on and off. It actually doesn't make much difference. But we think that intercept is important to capture potentially time-varying term premia, which are embedded in our estimate of the neutral rate because it comes from a macrofinance term structure model. So let me show you the predictions of bank rate in that model, which are here, and also a Fed funds rate forecast similarly, with the market curves now shaded in the background. The aqua line shows the proper recursive out-of-sample forecast, and the orange line, the rule of thumb forecast with a fixed intercept. Now, we see that because of the underlying measure of neutral depends on the entire term structure of bond yields and both nominal and real macroeconomic trends, it is able to react during turning points. Our main evaluation exercise is shown in the next chart, which is the Giacomini and Rossi test. Basically, you take a loss function, which is mean squared error of the alternative against the null over a moving window. And this was actually quite surprising to me. I thought the model would do well at points where pi star and R star historically moved. Maybe pi star was moving in the 80s and 90s, R star moving around the global financial crisis, and that's when the outperformance is very highly statistically significant. But in fact, the model-based estimate outperforms almost all the time with a positive number here. So that when that colored line is above zero, it means the model-based neutral rate was a better predictor of future rates than outsourcing to the market curve. That's been more often the case than not in recent decades. So I hope this will assuage some of the fears that model-based estimates of R star are fundamentally deficient or too imprecise to be a guide in real time. They are no worse than the bond market and often better at predicting future short rates. And the point is, we often seem relaxed about using the market curve to infer the endpoint, or in constructs such as the real rate gap. Yet the curve seems to have less information than the R-star models themselves. Thus, I would argue that these sorts of estimates of the neutral rate can be useful for coordinating actions and plans of economic agents in the economy, in line with a common baseline. And in my personal view, the key would be to publish these neutral rates regularly, consistently, and transparently in our monetary policy statements. I think it can be a hugely valuable thing to have a well-understood tool for communicating the degree of stimulus or restrictiveness. And without a view of the neutral rate, one cannot really have a view of restrictiveness. So I believe the MPC would be well served by finding a vehicle for communicating these beliefs. And there are many potential ways to convey these estimates, as judged by the various members, the Fed's dot plot and the Riksbank's rate path being just two examples. So I want to leave you with, in the name of transparency, an update of my own rate paths. Seems fair, since what I've just talked about. Including endpoints. I first showed a picture like this in my first speech in January. Recently in May, I voted to cut bank rate by 50 basis points, and in June voted for a 25 basis point cut. And my reading of the deteriorating outlook suggested to me that we needed to be on a lower rate path, needing perhaps 5 cuts in 2025 rather than the market-implied gradual pace of 4. So previously, when I joined the MPC, I think, like many, I had seen a UK soft landing in the cards, with some remaining upside risks to inflation as we ended 2024, and as a bump emerged in 2025. But now I think that soft landing is at risk, and there seems to me a greater probability of the downside scenario in 2026, which would push us off track as demand weakness and trade disruptions build. Shocks from energy prices and food remain a big unknown, but the underlying demand-supply balance is quickly shifting as slack opens up. Beyond that, using the model as we go out towards the end point, I estimate the UK neutral rate to be about 0.75 to 1%, putting neutral nominal at about 2.75 to 3%. Getting there under our baseline scenario without further shocks would take more time and a continued removal of restrictiveness in 2026 and possibly into 2027 as the economy returns to long-run real and nominal equilibrium. However, as always, a lot can happen between now and then. Thank you.
Thank you, Alan. And the design of the Sintra Forum is we do invite, of course, academics, central bankers, but also market participants. So whether here in this session or over the breaks, no doubt you may get some reaction to that. But I also picked up from Alan's speech. It might have been the first time in the history of the Sintra Forum that cricket was mentioned. The reason why I bring up cricket is it goes back to this issue that Alessandra raised about machines. Because, of course, cricket is ruled by the English Cricket Board, the ECB. And the amount of times I get alerts about the ECB and I get into a panic, and it turns out the ECB, the English Cricket Board, has made some mistaken decision. And then, okay, so, I hope maybe in your influence in UK society you can get them to change their name. But maybe that won't happen for historical reasons. So we've covered a lot. And maybe I will try and gather some of the main points into 3 issues. And then I'll ask each of the panelists to see if they want to comment on any or all of those. Number 1 is the technology that Alessandra raised. And we do have this issue now that we hear what Reuters and your competitors are doing, and more generally, how does it change how central banks should communicate? On Monday, when we launched our own strategy review, as we did the last time, we also accompanied the technical documents, the professional documents, with kind of layered communication, including animations and so on. I think this has been successful in recent years for monetary policy, but that's just one example. So we have, how do you get to the firms and the households? Versus the fact we can use the market data or the survey data to assess the professional response. A second issue, as Anna raised, was in relation to scenarios. We did commit on Monday that in a systematic but context-specific way, we will make greater use of scenarios. But essentially, I mean, you were very helpful there in how you presented, but maybe the other panelists also have comments. With those three issues, the technology issue, the measurement issue, and the scenario issue, maybe I'll go back in turn. So Alessandra, I don't know if you want to pick any of that up.
Yeah, sure. I mean, on the technology issue, I think that, as I said, in my remarks, what we have seen is that the AI tool, which is fast and picks up a lot, does not distinguish. It does not have hierarchy. And so I think what follows from that is that there has to be clarity and simplicity, or sort of a kind of clear repetition of the message, on the part of central banks. The fact that the tools exist and they're only going to get stronger, and the fact is, with all the precautions that I mentioned, we are going to use them more. And so that's just a reality for you. And so I think the simplicity and clarity is important. On the scenarios, I'm not equipped sort of on the technical aspect. I would say, I feel like the danger with scenarios is that can they be exhaustive? And therefore it achieves, to a certain extent, your desire for transparency, which we all agree is a good thing, and because you're essentially telling the market that there's more possibilities. It gives you an insight into what you're thinking. But if you're not exhaustive, then, and as President Lagarde said yesterday in the policy panel, we're not in normal times, and something that is a complete shock, a new shock comes out, and you have not taken that into account in your scenario, then, and the lawyers in the room, including President Lagarde, will say this, oh, well, you said it was going to be these X number of scenarios, but it's something else. How wrong were you, right? So you set yourself up, in a sense, for potential danger that way. So I think it's a balance between the need for transparency and the need for, not to then miss something, or name something severe. But as we have seen with COVID and what has happened over the last few years, there is no limit to what severe can mean. So I think that. And then just the final point, I would say, look, for us, from our point of view, which is what I'm trying to give you, for us, that informal, scenarios or no scenarios, that informal communication that our journalists, are really experienced and knowledgeable journalists have with policymakers is very important. It doesn't necessarily lead to a story, but it gives us the understanding that pervades all of our coverage, and at the end, leads to what we think is a more reliable and accurate product.
Okay, thank you so much. So, Carolin.
Thank you so much I really learned a lot. I think using, in terms of measuring a perceived reaction function, I think it's possible. That's what I've been hoping to show. I like to use complementary tools, so that's why I showed separate results for surveys, which have been out there for for decades. And market data, high-frequency data around macro announcements, bond stock betas. One could try to synthesize this into one indicator, but I think I prefer to look at three different things and understand, okay, this is maybe more long-term assessment, maybe this is a little more short-term, this might be a different sort of clientele that we're reflecting in principle, and could extend this to households using existing surveys that have been out there. I think one positive message from this is also that it seems like the forecasters and the markets that we're looking at in our data, they do seem to price in a reaction function. Whether it's the right one or not, I think it's actually probably not too far off, but even separate from that, I think it's positive that the data seems to speak towards forecasters and markets are going beyond just the point forecast for the next meeting. They are pricing in a slope. So I think that's good. At the same time, in our work, we've always stuck to fairly simple rules, similar to a Taylor type rule, with maybe inflation output gap, maybe a financial conditions variable in addition. But we've always tried to keep it somewhat simple because the data at some point reaches its limit. Maybe we have a cross-section of 30 to 50 forecasters, maybe 4 to 6 forecast horizons. But it also seems plausible that there's just a limit to how much these forecasters can process. So they seem to be able to process quite a bit, but we've always been trying to be mindful that there's a limit to that also. In terms of which tools are useful, the data that we're using is most similar, I would say, to the Fed's dot plots with the additional tool of being connected, right? So the way that dot plots are published in real time is there's a scatter plot for rates, there's a scatter plot for inflation, there's a scatter plot for real GDP growth, but you don't know whether the person who forecasted high inflation is also the person who forecasted high policy rates. And in a way it becomes available 5 years later, but basically the data that we use for private forecasters is like having this connection in real time. And I can't really comment on the practicalities of either scenarios or this sort of exercise, but for us, it's kind of, what I find useful is that it's basically like generating experiments. One person predicts more inflation. There was team permanent about inflation. There was team transitory. And how does this translate into different policy rate forecasts?
Very good, thank you. Anna?
So I think in addition to what I just said about scenarios, maybe just a comment on whether we can be exhaustive. I don't think we can. There's always going to be black swans, circling above, waiting to hit, right? So, but I don't think we should let this drive for perfection get in the way of using a tool that I think can make us more predictable. So I think that we can capture the risks that we see as important, and I think that's good enough.
Thanks, Philip. Thanks for the cricket suggestions. I'll try to take them up. I'll come back on scenarios too. Coming on a panel, it's not interesting to really listen to yourself. It's interesting to listen to others. Anna's presentation, I thought, was really great on summing up scenarios and how to do it. So we've been doing them for a while internally, many central banks, but now the question is, how to present them externally. And I think that's an art that's emerging. And how best to do that is a big question. I agree we can't be exhaustive, otherwise you're going to end up with, some kind of new fan chart with 1 million lines on it. And that wouldn't be very helpful in terms of communication. I think what Christine said on Monday night was important. They have to be context specific. They have to relate to some economic mechanism and economic story that's developing. And that's going to need work. And you will have to figure out how to update that so it's not stale and so that it's relevant. And I think that needs more figuring out. One question will be, how extreme should the scenario be? Are you looking for the 60th or 70th or 95th percentile? Then you're talking about very different kinds of events with different responses and risks. I think there's a danger in scenarios. I'll switch from cricket to golf, since we're at Panellists. There's a danger that it becomes like picking the golf club, like, well, here's what the 7-iron does, and the 9-iron puts it up there, and the 5-iron puts it down here. And well, yeah, actually, for me, it goes over there. But there's a danger that you just have an upside, a downside, and a middle, and it becomes kind of mechanical. And I think it has to be more grounded in an economic story than that. But I think the key is, and it's conveying the reaction function through what you're saying on either side. It's got to have an endogenous policy path. And I think, as Anna's presentation showed, that should be anchored around where you think the policy path is going, based on what I just said. I guess the last question for me is, in addition to showing these scenarios, are you going to speak about the probability weights that you attach to each one? Is that useful or not? Or do they just sort of sit there to be stared at, but no one's quite sure what the risk is? So I think there are still many moving parts to work out.
And that issue is, of course, reinforced by many things are happening which are not in the historical data set. So trying to say, well, based on historical averages, this is the probability, doesn't get you so far in some cases. Yeah.
Philip,
Alessandra, please.
Just a quick question, when you were speaking, sorry to speak out of turn, but a question I would have on the scenarios also is, does it potentially subject you to political risk? So if the scenarios are tied to policies, so in the case of higher tariffs, this could happen. Could you be seen then as promoting one policy or another? And I don't know the answer to that, but it seems like a potential risk.
It's, at least from my point of view, it's something we definitely take into account. But of course, in the end, there's a reason why we're independent. You do have to kind of call out what is relevant for decision making. So I see. I'm just going to go in the order of how I see people. So Isabel has the advantage of being right in front of me. So Isabel, then John Williams, and then Steve Cicchetti. Okay.
So thank you very much for a fascinating panel. So actually, I mean, so we have a panel about central bank communication, and most of you talked only about how we communicate to experts. But actually, I think what also matters greatly is how we communicate to the general public. And I would say we're pretty good at communicating with experts. I mean, we can improve and have scenarios and so on, but we're already at a pretty high level. But we may not be as good as talking to the general public. And of course, we have a situation where there is a general mistrust in institutions, in elites, which makes it very hard for us to communicate to the general public. I mean, we've all had our experiences. I mean, in our case, for me, the most extreme experience was we had back then in the old days, we had this narrative of the expropriation of the German saver by the ECB. And that was a very powerful narrative, and I tried hard to dispel that, but it was actually very hard. So, of course, when interest rates are high, you could also, at other places, have the narrative that a central bank is unnecessarily imposing a huge interest cost on a certain government. And the question is, I mean, how do we deal with that? And I think it's really hard. So there was one of the Young Economist papers, which is very interesting, said the messenger matters. And it matters how similar you are to the people you talk to. I mean, we are not similar to the general public. Let's face it, we're a bit special. We're similar to the experts. We are not so similar to the general people. So do we need different messengers to convey our messages? Do we need to do much more about things like financial literacy in order to make sure that people are better able to understand us? So what is it that we have to do in that area? Sorry for the long question.
Thank you. John.
So first and foremost, I want to congratulate whoever organized this session. This was awesome. It was great bringing the policymakers, academic, the world of journalism together in one conversation rather than one or the other. So that was, and each presentation was terrific. Second comment, again, on the positive, Anna, it was a fabulous presentation, but I also just want to applaud the Riksbank and quite honestly the Norges Bank and the Reserve Bank of New Zealand for decades of kind of showing the way about transparency and clarity along a lot of dimensions. Mm-hmm. We all learn from your experience, and your presentation adds to that in terms of what you've been doing recently. So I think that's great for these central banks to be experimenting some, and we can all learn from that. So I guess I have just two quick questions really. One, and maybe it picks up on Isabel's question, but a little bit differently. A lot of the ideas that are out there in the academic world are being discussed, and scenarios is one, seems to be the attempts by central banks to tell a bigger picture, tell more information, give the full picture. Let's give you 100-page reports in a way. When I think about the new technologies and AI, it wants to simplify to very crisp, short messages. So I guess there is this issue of how do we make sure that with AI and other technologies that fuller picture gets conveyed, who are the audiences for that, and how do we do that effectively? And I guess the other quick question is around scenarios, is really how we think about what's the kind of scenario that we think is most effective. I mean, I think, Alan, you might have said this, is like, this variable's up, this variable's down, that these are all endogenous variables. So is it better to think of scenarios as one as some kind of factor, driver is happening? I'm going back to my youth when productivity growth was the big question. So you could ask the question, is productivity growth higher or lower, and then work out what that might mean for the economy, as opposed to this endogenous variable moves in this way versus that. And I just think it's an open question. So again, just a fantastic panel.
Okay, thank you. Steve.
Thank you very much. I'm Steve Cicchetti from Brandeis University and the ESRB. Let me echo what John said without repeating it about how great the panel is. I want to take what I view as a very unique opportunity to ask a journalist a question.
I'm not used to answering questions. I'm used to asking questions.
It was a terrific. It was absolutely a terrific presentation. But I think all of us in this room have played around, and some of us use these tools more or less intensively. And one of the ways you can use the tools, if you're writing a report, for instance, is to put the report in and see what the executive summary is that the tool gives you, and see whether or not it actually matches up with the executive summary that you want. And if it doesn't, maybe go back and rewrite it. So my question for you is, there's a form of an arms race going on here, where the central banks are now going to use the tools to figure out what you're going to do with the tools, and to try and maybe manipulate you and your colleagues into writing stories that look particular ways by producing things that then yield AI-generated content of a certain kind. And I'm just wondering how you react to that problem or think about it. Thank you very much.
Okay, so I'll invite whoever wants to pick up any of those points. So Alessandra, if you have any response or...
Specifically on this one, well, yeah, you're right. I mean, it's an arms race. It's an arms race increasingly, not just sort of between or among us and, you know, the other news agencies that are doing, you know, similar things. And it's with the investment banks, you know, that are doing a lot of this, and with the central banks that are doing this. But that's why, I'm going to answer in a couple of ways. We are so careful to include the human in this loop. You know, the news judgment is something that and context is something that the machine has not understood. And so we have oversight of, and the human is very much part of the picture. That's the first point. The second point is sort of what I got to at the end, which is, we don't just, I spoke a lot about what we provide to the markets because it seemed like the right thing to say here, but you know, a lot of what we do, I would say, you know, even more of what we do is actually go out there in the street and report, you know, and that's not just with policymakers, but it is with people on the ground. And so we supplement what we report and what we put out, you know, of disclosure news, we supplement it with investigative work and sort of, you know, going out there, off the record conversations, and that is the huge value, right? The insight, the analysis, and the AI tool allows us to do more of that. So that's why we're so excited about these tools, because it lets us sort of, you know, go beyond, and that's our, you know, that would be our response. And just one other point is to the point of speaking to a public. You know, a lot of the information that we get from, you know, press releases and sort of the raw information that we put out into the market is essentially for the terminal. It's essentially for professional audiences. The insights, the analyses, the special reports that we write, those, all of our data shows, are read equally and consumed equally by a professional audience and the sort of market operators as they are by the media audience. So by our clients who are giving it to normal people, you know, more than 1 billion a day, every day. Those are equally as popular. And that indicates that the public does want to know about these issues, but they just need, and this is self-serving, but they need the journalist to explain what it means on the ground by speaking to the person whose mortgage has risen or fallen, you know, or what, you know, something that's happened in Ukraine means for your prices at the pump, and that's what we do.
Okay, thank you. Carolin?
Yeah, fantastic questions, and I'll say something about Isabel's and John's points, which I think are connected. And so in my QJ paper with Michael Bauer and Adi Sundaram, which we wrote for the US perceived reaction function, one of the findings was that the perceived reaction function moves after the classic monetary policy surprises measured as the change in in interest rates in narrow windows around monetary policy announcements. Now, why should that happen? Well, if you see a surprise hike in, say, an expanding economy, you might infer that interest rates have a higher coefficient on output. Or conversely, if you see a surprise increase in a weak economy, you should infer the opposite. And that's exactly what we find in the data. Now, what does this tell us about how much these professional forecasters know about the central bank reaction function? It tells us that they don't fully know the central bank reaction function. If it was perfectly known, there should be no response. And so that tells us that despite the intense communication efforts that have been there for decades, even the professionals don't fully know the reaction function. I can't fully extrapolate to households, but my guess would be that they're having an even harder time. That doesn't mean that communication isn't worthwhile, but I think it should be evaluated as we move along, and I think actions sometimes hit the mark.
Thank you. Anna?
So first off, thank you so much for the kind words, John, and I appreciate that very much. Excellent questions, difficult. Isabel, I think you're spot on. I think we need to understand why the inflation expectations of households, for instance, differ so much from actual inflation rates. And that could be linked to financial literacy, as we heard also in one of the young economist talks, right? So very interesting. I think we need to have a communication strategy where we communicate differently to different target groups, right? And I think for in terms of scenarios, we need to have, for internal use, a very specific idea about what we're doing, what are the assumptions, what are the specifics. But in terms of communicating towards households, maybe we could be a bit more concise and just, I mean, the main point is that it might not, evolve as we foresee in the main scenario. And for that, for investment decisions, if you want to buy a house or whatever, it could be that, that's enough that, you shouldn't take this as given, so to speak. Maybe we could publish technical appendices to go with these statements. I'm not sure, but we should think about that.
Thank you. Alan?
I second what Anna just said about communicating data. It's not just about explaining the stories, but if you feel like, there's a misperception out there, I think that communication channel, particularly with households, as she mentioned, is very important, and we can do more of that. I think our challenge as we go to more channels, if you like, of communication is consistency. If we're trying to reach different audiences, I think it's very important that the message be consistent, because it would be a terrible accident to be find yourself with different messages and be caught out on that. And I think that's an art of storytelling, that our economic models are ultimately stories about how mechanisms work together. And I think it's just a matter of crafting those messages appropriately. And then the last thing I wanted to pick up on was the political risk, and can you talk about the impact of fiscal policy or trade policy? Well, of course, we have to do that because it's going to affect the trajectory of the economy, and it's going to move the output path and the inflation path and require a response from the bank. So it's going to be part of the story we have to tell anyway as an independent central bank. So I think you would only repress that if you were a non-independent central bank, but
Very good.
I don't want to be in that world.
Okay, so the next set will be Jordi, Michael McMahon, and Annette Vissing-Jorgensen. So Jordi.
Just Jordi Gali, Carolin UPF. Just a quick comment on Alan's presentation. I think I agree completely with you that it's critical to be transparent about the long-run neutral rate, while acknowledging uncertainty about it, as the Riksbank does. Yeah? And the analogy of it is, asking Google Maps for the best roads to take, given the current congestion, without telling it what your destination is. No? But I'm a bit so. But I'm not sure that the approach that you described is one that would be useful for central banks themselves in order to make inferences about that long-run neutral rate, because it's based, if I understood it correctly, on estimating the intercept of an interest rate reaction function, which, if anything, would capture what is the long-run neutral rate that is consistent with the policy that the central bank is actually pursuing, and hence maybe based on their own estimates of the neutral rate. But I think we should go beyond that, and from the point of view of the central bank, it's interesting to understand, to know what is that long-run neutral rate, which is not something that they choose, given their choice of the inflation target. No? And for that, we need to go beyond that approach and to use structural models that incorporate the forces that we believe are the drivers of that long-run real rate, like productivity growth, demographics, preference for savings, and so on.
Thank you. Michael?
Michael McMahon, University of Oxford. I'll just make one comment. The second part of Ben Bernanke's famous 98%, 2% statement is the cost of sending the wrong signal can be high. And it's come up a few times, conditional statements being interpreted as unconditional, despite your attempts, forecasts being taken as promises. So I guess the general question is to the panel, how do central banks best convey the uncertainty? Or put another way, is the fan chart dead or is there life in it yet?
Very good, very good. Annette.
Yeah, I want to touch on the issue of disagreement. You know, as you all know, a lot of the communication from committees comes from the fact that people don't really agree that much. And so there's a big distance between, for example, the Riksbank approach of conveying a committee consensus to, say, the Fed's approach of having a dot plot and potentially connecting the dots. I wanted to ask you a general assessment of how much of that disagreement, you know, should one discuss and convey in the formal communication, in the sense that does conveying that facilitate an understanding of the committee's collective action function, or does it cause just confusion about it?
Very good. So because I'm mindful we're hitting the limit, I'm just going to ask Rafet to make his question, and then.
This is for Alan, but I feel we may want to actually take this, or any of the policymakers here. So if you wanted to communicate the policy rule clearly, would you be able to do it? Is there a rule that you yourself are aware of and, you know, say that, you know, this is how we make these decisions actually? We don't tell you, but it's there. Is this a communication problem, or is it a existence of a rule that is actually carried over more or less unchanged from meeting to meeting?
Very good. So I'm happy to hand that one over to Alan.
Okay. So do we really have a rule? I'll take the questions in reverse order. So as I wander around Threadneedle Street, there are pictures of banknotes, and I often, like, if I'm ruminating or thinking, I'll stare at the £50 note and the picture of Alan Turing and say, well, if he were here, he could probably just design a machine that could replace all of us. But we're not there yet. I think we all have models and rules that are fuzzy. They're affected by noise. They're evolving. So we're not in that kind of deterministic, mechanical world yet. On Michael's point, I don't think the fan is dead or should be dead in the sense that scenarios are not a substitute for the fan. They may be a complement. And there's actually a danger that if you just go to 3 lines instead of 9, suddenly they're just precise lines, and you're actually hiding the fact that, in fact, all forecasts are subject to noise and more noise as you go further out. So if that somehow got forgotten or left behind, that might be a retrograde step. And then on Geordie's point, you know, I guess following Andrew, I was just trying to be humble and do a little nudge here, kind of make a very modest point that we put a lot of weight on the market curve, and we use it as a benchmark, and we trust a lot in it. And this was just a kind of horse race to say, well, actually, does it do that well? Well, alternative models might do better. Here's one. Should that be the only one? Maybe we need to go to a world of ensembles and model averaging and trying to figure out from a variety of models appropriately weighted where we think the best estimate of that long-run neutral rate will come from. But I think that would be a constructive step. And I'm arguing particularly in terms of communication, getting away from tactics and more towards strategy of where are we going. I think it helps in that regard. And as I said, I think the Riksbank example is a good illustration of that.
So, Anna, I don't know.
So just 5 seconds on Annette's question, perhaps, because I know we're out of time. But I think you're absolutely right. I mean, institutional differences are a huge thing, and that for the Riksbank with 5 members on the executive board, it could be easier for us than for the FOMC. So absolutely, that's a very good point.
Very good. Carolin, do you have any?
Yeah, you know more about the internals of the Fed than I do. I think it's a fascinating question. We have found in looking at the connected dot plots that are available with a 5-year lag that the connection, the relationship that you find has some differences, but also has some similarities in terms of the implied rule from private forecasters. So it doesn't seem crazy, but I think the broad message is kind of numbers on different outcomes, different policy rules, whether it's connected dot plots or scenarios, is a good thing. Regarding Refet's question, I mean, the plots that I showed you, if I said monetary policy rule, I misspoke. I try to be careful and say reaction because the implied reaction varies so much over time. So in a way, what I've showed you, I think, looks more like a highly time-varying reaction function than a constant rule.
Very good. Alessandra, if you want.
Really quickly, I mean, on the disagreement issue, all I would say is that it is hard, my experience sort of is more than 30 years as a journalist, it is hard for things not to come out. If there is disagreement and it exists, it will come out. And so, and again, this is self-serving to a certain extent, but, that disagreement or difference of opinion, in the hands of a professional journalist who understands the context of what it means can then be explained. And then just on the issue, financial literacy, Isabel, you raised it. Financial literacy is key. Young people now, let's face it, they don't trust mainstream institutions. They don't trust central banks. They don't trust, traditional media. They get their news from TikTok. That is the way they get it. And so from influencers, a recent report showed that the rise of influencers in spreading news is incredible among the young sort of 15 to 25-year-old crowd. And those are our consumers. So I can just say what we are doing, because we do speak with the public, is we are embracing these formats. We have different formats. We work with the social media companies. We are on TikTok. We are on YouTube. We are even on Twitter, X, because that is the way to reach the younger population, and that is just a fact. You can't fight it.
Thank you. So maybe in closing, I'll make 2 points, because Rafet asked a really sharp question. So what I would say is, from my point of view, the reality is, there's a whole family of future rate paths. And rather than obsess about, this one over here versus one very close to it, what we've tried to do with the criteria we've used to say, well, if you're trying to work out where in that space we're going to be, on top of the looking at, because you said all you can do as an academic is look at simple rules, on top of expected inflation, underlying inflation, the strength of monetary transmission will help you move around that kind of family. And maybe just coming back to the 298 ratio of Bernanke, I think we didn't quite settle everything here, but I do think in communication there's maybe some combination, 2 pages to explain the most recent decision. So being simple, being clear, and then 98 pages to go through the nuances, the scenarios, the model assumptions, the risk assessment. Maybe that's where we'll end up, maintaining 298, but in a different sense. So with that, let me thank my panelists for a really interesting session, and let me hand it back to Claire.
Great job.
Very good.
Yeah.